Hi, my name is Mark and I teach economics. Today we're going to look at and answer the question, what is the most fun you can have with your clothes on? Is it traveling the world on a shoestring? Is it bungee jumping? I have a better idea. Stocks and bonds. So we're going to look at stocks, bonds, corporations, and what this means from an economic standpoint. We're going to ask some questions. What is economic profit versus accounting profit? And let's go. So first, to understand this, you have to understand what are the different types of corporations or at least legal entities in the United States to make money. You have sole proprietorship, you have partnership, and you have a corporation. Now, sole proprietorship is pretty straightforward. It's a person owning a restaurant or a small business. And sole proprietorship makes up the most number of, in terms of just sheer numbers, of types of legal entities doing business in the United States. Corporations make the most profit and generate the most revenue. However, they're not the most profitable. Their return on investment is less than sole proprietorships. You've also got something in between, a partnership. Partnership is very similar to a sole proprietorship, except you share responsibility with a person. It's never a good idea because the idea of diffusion of responsibility in psychology comes into play. And when you have diffusion of responsibility, you know, your boss asks you to do something yourself, you're going to do it. If he asks a team to do it, well, you know, there's less stress because it's the responsibility of the whole team. And the similar idea is in a partnership. There's diffusion of responsibility, but the same idea is that sole proprietorship is funded by, and the partnership is funded by the partners primarily. And they have unlimited liability. So this is the key characteristic of partnerships and sole proprietorships. They have unlimited liability usually, and they are funded by their owner's equity. Whereas in the corporation, you have limited liability. You can have a corporation or LLC. It's limited to the investment which somebody puts into it. In a sole proprietorship, if somebody sues somebody, they can take not only the assets of the business, but the house, etc. So the corporation has this advantage of limited liability. It also has the advantage of greater ability to raise funds and capital, and it will fuel their business. But it has the disadvantages of certain tax, almost double taxation. So there's pluses and minuses of each, and you want to know, again, there's two basic forms of ownership. It's either direct ownership of the owner, and that comes under sole proprietorship or partnership, or corporate ownership, indirect ownership, or in a sense, usually a corporation, but sometimes in an LLC, limited liability corporation. Conceptually, there's two, and different books break it out into 3, 4, or whatever. Now, the core part of this is how businesses get their funding. A corporation has to raise stocks and bonds, usually, and that is called direct funding. They go directly to the people, and they can sell a bond or sell a stock. Whereas there's something called indirect financing, which you have to go through a financial intermediary, a bank. Well, sole proprietorship would most likely do something like this. But corporations can do it. They can go through investment banks, and there's different avenues. And we're mostly concerned here with this direct financing. That is, corporations around the world and in the U.S. go directly to the markets to raise capital through stocks and bonds. Now, if you think about it, the stock market, what is it? You hear all these movies and drama created by Wall Street filmmakers and Hollywood and the media. But what is it really? The stock market is all the publicly traded assets. In Wall Street is all the publicly traded assets basically of the U.S. on the auction block. It's one big tag sale, one big auction. And at any moment, people like you and me, we can go buy these corporations. Who owns Google? Who owns Amazon? Who owns Disney? People. I can go out and buy one share of Disney, and I am part owner. And usually if it's common stock, I have voting rights. This is equity ownership in the company. Equity means it's actually capital that you contribute. In contrast, a bond is nothing more than a loan. A bond is it's a note, a promissory note that you loan the company money, and at maturity, you will get that money back. And in between there, you'll get coupon payments. Payments on a regular fixed schedule usually. It's a legal obligation, so if the corporation can't pay this, it will go into default, into bankruptcy. Whereas a stock, they do have dividends, usually in older companies, established companies, where newer companies put the money back into the company and don't pay the dividends. There's no legal obligation usually. Companies can say, tomorrow I'm never going to pay a dividend, and even though you're the shareholder, you're not getting any return unless there's capital appreciation. So the difference between a stock is ownership in the company, where if you hold a bond, you're lending money to the company. And from the corporate's perspective, ownership, if you issue more and more stocks, you dilute the ownership. There's too many cooks, it will spoil the broth. Whereas with a bond, you don't dilute the ownership. You could have one owner of the company owning 100%, and he just simply has this legal obligation to pay. Why is this significant in economics? Since corporations make most of the profits and most of the revenue, generate most of the revenue, they are most of the activity, let's just say, in the economy. And if there's a disruption in this financial market, it can have a real shock to the real world and result in unemployment and price fluctuations such as housing or capacity being decreased or increased. So it's almost like in economics you have two worlds. You have the real world, brick and mortar, and you have the financial world. And when the financial world is in disequilibrium with stocks and bonds, then it will wreak havoc in the real world. And that's why we're talking about stocks and bonds. So let's first look at bonds. Bonds we know are promissory notes. How do we know these bonds, these pieces of paper, are good? How do we know they're credit worthy? There are three, let's say, independent rating agencies, Standard & Poor's, Moody's, and Fitch. And these give you ratings. D is the lowest. That's default. You can't get an F. You can get a D. It's a pretty good deal. But D is default. AAA is the best. And these corporations, they can assign investment grade, triple B, or triple B plus, a different rating, a grade for each one of these. And they evaluate it based on the corporate balance sheet and income statement. The balance sheet looking at the assets and liabilities of the corporation. The income statement is clear. It's how much revenue or money they're generating on, let's say, a yearly basis. So again, corporations, they go to the market to fund their capital expansion in their operations. They go through mostly direct financing through stocks and bonds. Credit agencies rate the financial viability of corporations. They give it a rating, D for default, AAA through highest investment grade. And then there's some grades in between. They base it on the valuations. Analysts, credit analysts, look at income statements, which is the income of the corporation. How much did they make each year? That's revenue minus costs. And they also look at the balance sheet, how many assets they have, how much liability do they have, how leveraged this corporation is. If they have a lot of assets, but it's all debt, that's a risk. They also look at cash flow. It's a separate statement. You have the balance sheet, income statement, and cash flow. You can have great income, but if you can't make your cash flow on monthly payment, it's like you can't make your bill payments for a mortgage or a house each month. And the agencies will rate this. Now, in the crisis of 2008, there was some perhaps conflicts of interest, and the agencies did not perhaps properly rate the debt that was out there. People were holding debt that was worthless or low valued, and they thought they were holding AAA debt. This created a financial shock, and the financial shock had an effect on the real economy. And here in Florida in 2011, you could see that in housing prices. It was like one of the epicenters of defaults of the real market. And so at the end of the day, where are we? We have a market of stocks and bonds to raise capital directly, and this is the financial market, the main lubrication for the engine of the economy. And when this is misaligned and in disequilibrium, whether it's because information isn't perfect, and the price, which is basically a valuation or an expectational valuation, and a measure is off, this will create disequilibrium. After the crisis in 2008, the government tried to step in and create financial regulation and control in laws, like the Dodd-Frank Act. This helped regulate and oversee financial firms. But it's a double-edged sword, because when you have financial regulation, you know the effects. More regulation, less innovation, entrepreneurship. And that might be one of the reasons why we see today less entrepreneurs under the age of 35. They're shackled by the bonds of regulation. So the direction of the economy in our future is largely going to be a balance between this regulation and, let's say, wise and prudent regulation versus unregulated, the wild, wild west. And in the end, we hope to have a stable financial market, because when you prevent financial shocks, you prevent economic shocks largely. And that's stocks and bonds. That's the stock market. It's not some bad person on Wall Street. It's actually you and me ownerships and part of corporations. And bonds, the bond market, it's not, again, some big corporate bank somewhere. It's individuals, pension funds, your IRA, your 401k. It has this in it. The school, it funds it. School loans, student loans, mortgages. It's you and me owning these or lending this money. Thank you very much.